The 2024 property market crash. There's a ton of people out there that love telling you the crash is coming. Like an economics professor who walked 200 Ks from Canberra to the top of Mount Kosciuszko, all because he lost a bet that house prices would fall by 40% in 2010. Or another economist in 2019 who was still screaming crash before the third largest property boom in Australian history. There are so many more examples out there. In this two-part series, I'm going to explain the story that the data tells and why I feel backing the doomsday advice could potentially cost you your financial future. And in the second part of this series, we're going to unpack a little known phenomena called the crash fallacy. But right now, let's jump into part one. Well, as we're going through part one, I want to break down core trends. Now, remember, these are not the only trends. And if you want to understand all the macro trends to analyzing house market fundamentals, there's actually a free research paper available for download, and that's called Australia's Housing Fundamentals. And we produce this annually. Now, if you'd like to get the most recent one, and heck, even get the last year's one to see what I said then and how that came to fruition, you can jump on the InvestorKit.com.au website and click on the White Papers tab, which gives you a detailed property research and the actual Australian Housing Fundamentals review. But for now, I'm going to pull out some of those key trends and talk about the actual market crash in 2024. Is that coming? Is that not? We're going to break it down further. So the first core trend to analyze whether a core crash is coming or not is actually the job market. And if we're looking at job market data here, it is super strong overall. Now, there has been some cracks at a surface level of weakening, but that's common if you're going to hammer Australia with interest rates and change the actual direction of monetary policy. But it is still very resilient with unemployment data, as you can see here, or listen here, is going from 4.4% back in Jan of 2022 and has continued to come down. Now, it reached the lowest it had reached sort of November 2022, which was just over 3%. But now this has hovered a little bit back up, which is understandable considering the interest rate rises. And now that's hovering still below 4% at 3.5% at the time of this data release. So I think the key here is to firstly highlight that there is no weak economic job market position from highs of job advertisements and very low unemployment rates across the nation. Now, again, the trend is back up, and that's normal considering interest rates have been rising, and that will get weaker the longer we stick at higher interest rates. However, it is coming off an extremely tight and a low base, and the intentionality of interest rates to calm down inflation and also actually create some unemployment is part of the reasons why that trends needed to happen with interest rates, and they do flow on to the trends of unemployment changing. However, it is still very, very low. Now, the next data point we're going to look at is actually wage rises, because low unemployment, strong job advertisements, therefore, it should have a flow-on impact to wage growth. And the data's been super strong on the wage growth. Now, I will throw in one sort of bullet point on wage growth that talks about real wage growth, because there's inflation and the cost of things on one side. We'll park that aside for now, only because I want to isolate wage growth itself. It is happening. Because remember, inflation can calm down, but usually wage growth, wages will continue growing. Now, they won't grow at the same rate all the time, but right now the numbers are extremely strong. So if we take a look at the data here and we look at ABS and see what they've shared, the quarterly trends were very flat, sort of 2015 to 2020. Now, COVID quarters changed that data. Things took a back step. But then from 21, the trends have been explosive all the way through. 21, 22, and now 23, the recent quarter, was monstrous for wage growth. We can see that wage growth trends have surpassed decade highs. So this is not just a last year, 3 years. It hasn't been this good for over a decade. And the Australian Wage Price Index quarterly and annual trends, in the recent annual trend, we've seen this spike up like no tomorrow. Remember, this trend has been downtrending from 2011 all the way through to 2019 before a slight recovery, and then back down again to COVID period. So this has been a strong and recovering trend, which shows a high level of wage growth and confidence in Australia's employment market. The next part is around building. So when we're looking at building, I like to look at it from a perspective of housing construction index. the changes in quarterly and annual numbers just to start looking at short-term and longer-term data. And the purpose of this is to see, like, when you're looking at new build data, if it is seen as an expensive option, which it always will carry some premium, but if it is expensive by a mile in comparison to established pricing, if it is heavily delayed, if it is uncertain, then the lift of established pricing goes up. But also if the new build pricing continues to be higher, even just automatically building has created price growth, which is a very unique phenomenon. It doesn't exist long term, but it's existing right now. And so just by building, because the cost to build is higher, prices are higher. And if prices are higher, growth has occurred because established gaps between new build pricing become larger and established pricing then has to catch up. So that gap isn't so large, because if the gap's too large, then you just have the pendulum swinging in one way. And we can see this trend clearly. If we look at, the pre versus post-COVID impacts, the first thing we're looking at is quarterly data. And I'm looking here at housing construction index for quarterly and annual percentage changes. And that index number has been rocketing up. As soon as 2021 came through, that cost index increased substantially from 2020 December quarter to 2021 December quarter. It was massive. Now, there is some good news ahead in some parts, which is that the costs of construction has been coming down. The peak was reached sort of end of, let's say, start to mid of 2022, kind of going in line with interest rates sort of changing and increasing. When interest rates started to increase was one aspect of it, and just the global trend started to recover. You can see the input to house construction index has been trending lower. It's actually coming much lower now that it's trending as a percentage change, but the actual overall index number is still high. Right? So the index number is still high in terms of the net cost, but the percentage change of growth has completely come off back to pre-COVID trends. It's just fallen off completely. So what does that mean? Is there's still that lag that will happen from all of that cost increase, that when construction occurs, just because of that index number being higher, the cost of producing those houses is more expensive automatically now. And so if it's more expensive now, it therefore means that anything just being built, not even in a quote-unquote good area that's in high demand, just being built is more expensive. And if something is more expensive, unintentionally, that's capital growth, because it's now costing you more to do the same thing than it did a few years ago. So when that's more expensive, that's clearly to say that established house price gaps can keep getting made up. And if it keeps getting made up, then prices aren't falling because new builds are just so much more expensive. Now, what does that mean for future, though, is that these costs are now stabilizing and or coming backwards, which means that this pressure cannot stay this hot forever and things will eventually calm down. But that has a lag effect. Remember, people need to start more with approvals. People need to then start more starts, the actual construction starts, and then completion. And that could be a 8-month, 1 year, 2 year time period, sometimes longer. So you can't say that just because that index has come off now, that prices will fall off. It's just not. Now, construction cost was one element. I mentioned the time towards the end. If we're looking at this chart here, houses are taking longer to be built. House construction commencement versus completions. It's clear that there's a lag attached here from the commencement and completions. Now, you'll see a big commencement jump up when it comes to the actual home builder period. So that was a sugar rush. But the completions are still falling off. So there just is not this high level of completions that matched that construction start. And by the way, if you can't see these charts and you're listening on iTunes or Spotify, jump onto our YouTube channel, give us a like and subscribe and check out some of this content. We get to see some of these charts. But if you're listening, I hope I do a good job of trying to actually show you through the words by saying that, hey, look, housing completions are just not there to the level of commencements. And that has always been a trend that followed closely, but since that huge sugar rush and the impact came through from home builder, we just haven't seen that match occur, even with a lag attached to it. It's still a big gap. So that construction supply isn't quite meeting the market just yet. So when you don't have construction supply, when you have construction costs the way they were, that creates more confidence for established housing to lift up. But eventually that will calm down, as I mentioned, because that index of cost is coming off and hopefully confidence then recurs in that construction space. Now, here's the big one. Crash alert or not alert, right? This is the part that really tells you what's happening. And this is housing supply. And we're looking at it of listings today in comparison to 2018 and 19. And why is that important? Well, if we take a step back, we can agree on a few things. Are there more people in Australia today than 5 years ago? Totally. So, with more people in the country and more households created, because remember, average household size went down, and so therefore more households got created. So the same people are creating more houses needed, but there are also more people than 5 years ago. But guess what's happened to housing supply for sale? There is a huge fall off. If we're looking here at the chart, this is depending on the area, you're seeing between 30 to 50% reduction in housing supply for sale. And this is the total number of listings by SQM Research, which shows, firstly, the trend was declining since 2013. So this isn't new, but we can clearly see that as soon as, that sort of 1 year post-COVID, 2021 happened, 21 to 22 was some of the biggest drop-offs that we've seen in housing supply. And what we can also see is that the recovery, whilst taking shape nationally, it's actually filtered through just a couple of cities more than it is elsewhere. So for example, Sydney, Melbourne have been cities that have returned back to their longer term averages of supply, and the rest of the nation is super low. And so the rest of the nation plays a big part of that data element. And you can just clearly see here that it's 30 to 50% lower depending on where you are. If housing supply isn't available everywhere, how are people going to just say that everything's going to crash? Availability is the first part of crash, because if I have lots of choice, what do? Well, I don't have to rush the decision. Don't have to pay a certain dollar. Maybe I can put in a lower offer. Maybe I can put in 5 offers. There's starting parts to emerge. But you know what? That's not the case, because housing supply is very low. So this undersupply is creating an actual cycle, and this cycle is very impactful. Now, this isn't to do with the data that's just in front of you here from actual listings, but this is the triple effect that's happening in supply that I believe is the biggest factor of why there is no crash in 2024. There is a massive impact from this undersupply, and it's creating 3 core trends that just keep revolving around. Now, I want to display this as a bit of a triangle. The first top of the triangle is going to be undersupply for construction. So we talked before about the lack of building. Now, if we bring that down to the second part, we've actually got undersupply for sale. So not only is there construction that's less, new property, there's now established property that's 30 to 50% less in Australia. Then we draw it over to the third part, vacancy rates are extremely low. So for rent is now also difficult. So if we bring this back up to the 3, we all of a sudden start seeing less properties being built, less available for sale, and then less available for rent. This is a trifecta that's massively changing the dynamic of the market. And I'll just give you an example from sales agent conversations that are appearing right now. I've got a seller and they do not want to sell their property because they don't feel confident in their ability to build. So this is the connection to build and for sale. And they just feel uneasy about the timelines, where they will stay, and how long it might take or how much it may cost. They've heard bad news stories, so this is the link between the two. Now, where do they go, Arjun? If they're not selling now because they don't feel good about the construction, well, they go to the rental market, right? Well, they feel crappy about the rental market now because they just don't think it'll be easy to compete. They don't feel good about their job position or strength in comparison to maybe others who are applying, and they've been to a couple of rental open homes and the competition's nuts. They don't see what they like available. And now this becomes this huge thing coming back around. All of a sudden, you don't have the construction confidence, the desire, the patience, the risk appetite. You don't want to sell the established one, even if it's a good price, even if it's great money, and even if it's in your benefit. And because you don't know if you'll be able to buy easily or rent easily. Can you see the problem here? Because one side has not given, all 3 are creating a problem. There is no pressure valve that's being released for someone to choose a segment of the market that they put more into. If there was a high rental vacancy in markets across the country, then I could say, I'm selling with high profits. I'll go to the rental market and I'll think about my next thing. Makes sense. Or I'm selling with high profits. I'm going to the rental market. I'll sit there until I find the right property. Makes sense. I'll sell because I'm thinking of construction. I feel confident to construct. There's lots available to construct and it's not super expensive and I haven't heard lots of bad stories in recent times. So you see, this isn't the case. We're in this trifecta of something's got to give here for the market to give. And right now, construction's probably going to be the first one that'll give, but that takes time. There's a lag effect. So the likelihood of the crash happening is extremely low because you've got this trifecta occurring and something's got to break in this chain for supply to be back in the market. Either we've got a huge amount of people that just need to sell, or we've got the need to sell then arriving into now they have available rentals so they can sell and actually live somewhere, because no one wants to just throw their housing shelter up in the air and go, I'll just live on the street. Yes, there are many people doing that. I'm not saying that doesn't exist in Australia, but that's not what people want to do. So therefore, something has to be broken in this chain for it to start occurring. Right now, the likelihood of that happening is just super low. The next part that really makes it difficult for me to see a crash come to fruition is the immigration component. Now, the immigration component, I've mentioned in many data reviews and podcasts in the past, that it doesn't in isolation grow property markets, because if you have immigration come into a certain city, it's not a must that they must all build, buy, and actually all of a sudden take out mortgages the day they come off the plane. In fact, that's like the least of their worries right now. What their first worry is probably looking at just enjoying the country, meeting people, actually starting to look at job, employments, and starting to then settle into life, which is why there's data that suggests that it could be over 4 years on average that people start to move into those household buying decisions. So to think that that alone is the impact, it isn't. But remember, in the previous parts, I mentioned about that trifecta of supply for sale, construction, and actually for rent. The rental part is now factored in, because when you have many migrants coming into Australia, they're likely to rent for the first few years. So they're constantly adding demand to the rental pool. And that rental pool will then mean the rental market stays tight. It's part of that 3-part supply piece. So the next flow-on part is if they keep coming in, there's also money to be spent in the economy, because new people are spending. Even if it may be a coffee, that could be more coffee cups being sold now because more people are coming into Australia as a whole. And that will impact job data, resilience to actual spending data, although that can't just be truckloads of cash coming off every single migrant that comes in. It's not how it works. People are looking for many times a better life, not just, starting in and trying to have that better life immediately. It's a journey, right? And so I think from that perspective, the key thing is that it's a big supporting factor to the rental market in terms of the strength of the rental market, so rents to rise. But then also, secondly, it's actually a big factor to local economic activity with the economic benefits of spending. Where it becomes a weakness, though, is that at times you can have a larger pool of people looking for jobs because they're coming off the planes, they're coming here and looking for jobs. And if that larger pool keeps building and people's appetites to take on different costs of labor, for example, people's ability to go, well, I don't mind taking a lower paid job to get in, then there's more cheaper labor coming in. Even if there might be minimum rates to protect that, there'll still be cheaper willingness to do it because they are all or nothing coming in here. And so from that perspective, I think the key there is that unemployment tends to eventually rise. However, this isn't an instant impact, but in the interim, sales data or spending data is stronger, and also rental, actual people coming in for demand, is stronger. So that means that this is another element putting a big floor or big protection to Australia's likelihood of crash, because you have constant rental demand flowing, you have economic data improving, but then there's an element that will eventually flow through, which is unemployment may increase as a result of it too in due course. Now, that comes back to 2024, saying that is actually protecting markets from any downward movements from the rental aspect, which, coming back to my supply piece, that has an impact to construction and also for sale when you look at that, how they're connected. So that's the part around migration. Now, when it comes to migration, that flows into the next few parts, which is, internal migration too. Now, I don't have a chart for this internal migration piece because it's clear that right now there's trends, pre-COVID averages, COVID points, and post-COVID. We talk about, the regional migration boom that was happening. Tree changes, sea changes is a cool word that was used. Now, that hasn't come off completely. It has slowed from the peaks because we're starting to, just adapt to life the way it is, but it's still above pre-COVID averages. So there's still clearly demand heading to many regions across Australia more than it was pre-COVID. So that's another element of migration that's still occurring in Australia. But the final point to raise is that the worst is behind us in the eyes of many. And this can be done by data and looking into it around inflation, cash rates, and sentiment. So if we take a look at Australia's consumer price inflation, you can see that it reached its peak in 2022. So in that 2022 data point, it had reached as high as just under 9% of inflation, which is massive. And it is the reason why interest rates continue to rise up, that metric that the RBA was looking at. But you can see two things have emerged. A clear peak in the trend occurred and inflation is coming back down substantially. Now, it might not just fall down in the same head down way that it has been, but it will probably have some stabilization soon, only because we might see some flow on of certain data come into the mix, right? Now, when we're seeing interest rates, though, the point of the interest rate rise overall was to bring that data back to the 2 to 3% bandwidth that the RBA wants to see it at. It is getting very close to that. If the last few quarters and the trend line eventuates, it should be in that range within the next 2 quarters, if that ends up being the case. Which is why you can see so many banks starting to forecast interest rate cuts in the second half of 2024 and most definitely in 2025 in their opinion. And it makes sense for 2 reasons. Number one is if inflation is rocketing down that low, that fast, that clearly means it just does not have a smooth landing. You have to create a smooth landing through policy of money going in another way. And that's what the RBA needs to try and get right. Because the last thing they want is all the buildup of the quarterly trends that showed in October, November, December, and starting to have that data keep coming out, into it and go, well, it's quite weak sales data, quite weak retail spending, jobs start to get removed from the job advertisement portals, and we're starting to see rents still rise. So you can't just use that one isolated data and have the whole basket looked at in that way. There's many weakening parts showing of inflation in that economy. And then that element will then start to go, well, if we don't have the rate stabilize and or come down, then we've shot too far in that direction. Now, I've voiced it in the past that I felt that they shot too far in the interest rates, and that's why it's a nosedive. And if that continues to occur for 2024, well, then many people, both investors and just the general public, are feeling like the worst might be behind us, and they may hold on to that supply because they don't want to let it go if the worst is behind us and times are going to get better, and they might wait for those times to get better. And also there's those buyers who are active going, well, I don't want to be part of the seagulls fighting over the chip when everyone's back in, when borrowing capacities join the party as interest rates come down. I want to act before if I can. And so those who are acting before if they can are all of a sudden now another element of strength to the market through more buyer demand. And so this shows that the worst is behind us. I'm not saying there could be some more bumps in the road. Those bumps could still come up because inflation data in the nosedive could start to stabilize, but it's not going to really stabilize immensely unless the interest rates start turning the other way. And so I think this is a key thing that needs to be looked at in later parts of 2024, and why some banks are forecasting that this happens sooner rather than later, and others in 25. I'm of the opinion that it should happen in 2024, because with those rate cuts that happen in 2024, we should start to see that nosedive start to flatten out with inflation as more and more people feel a little bit more confident. And confidence is the next piece. We've already noticed it amongst our own client base of increasing inquiries. We're noticing amongst finance take-up in Australia, but now there's also another element of confidence, which is actually sentiment scores. So if we look at the Roy Morgan Consumer Confidence Index, that from late 2022 through to 2023 has been flying up. Now, is it at lows? Yes, it's still fairly low. It's by no means to the 2021 boom that happened, and by no means is it to the 2010, 2011 to 2015 numbers that rised up as well. But that number is improving a lot. Why would it be improving? Well, wages are rising, unemployment's low, house prices were resilient and stayed strong. There was no big crash in 23. Many of the cities that fell in 22 have had their gains come back in and recover 90% or if not all of it. And then now we're going into 24 with the chances that inflation is reaching bandwidth and interest rates are coming down. migration continued to come in, and people came into Australia wanting to see a better life and catch up as well on the gap of migration that occurred in the years prior. So you can see with the resilience in employment, the resilience in house prices, the resilience in jobs, migrants coming into Australia, and also housing supply being well placed and prices continue to stay strong. Now you put the last few data points of where inflation's heading and where sentiment's heading and where finance trends by ABS is heading, it's clear that the markets aren't likely to crash in 2024, and the way the year has started is looking like it's going to be a strong year in 2024. So it's using these data points, not predictions like economists have made in the past that have turned out to be very, very wrong. It's now using real data across those aspects of economy and housing to talk about the supply phenomena, to talk about the actual economic factors of Australia and what the sentiment and data points that reflect that sentiment are showing, which show that the crash is just not likely in 2024. If you're watching this on YouTube, smash that like and subscribe button. I appreciate all the love you give in the comments, the likes, the subscribe. More content like this will keep coming your way. Now, if you're on Apple iTunes or Spotify, drop us a review. Look forward to reading them, checking them out, keep them flowing, and more podcasts like this will keep coming your way.